Hello, this is Todd Wall of Aquatung Media, and I saw an article about everyone's favorite genius, amiable, good-natured, investing genius grandpa, Warren Buffett. Now, what's interesting is actually I know a lot of people who, for some reason, don't like him and think he's a phony and a fake, and I'm not quite sure why, because to me he never has quite presented that way, or I've never got that read from him. But in any event, this is an article about Warren Buffett, and the title of the article is "I Get Euphoric," is what he's saying. Warren Buffett once said he loves it when the U.S. stock market does one thing and highlights a huge advantage. And so, as the article begins, it says the stock market's ups and downs can rattle even the steadiest investor. While everyone hopes for gains, losses are inevitable. But legendary investor Warren Buffett once offered a refreshing perspective on how to handle those downturns. And this is his quote. He said, "I love it when the things we buy go down. I get euphoric. You know, the stocks are down today and I'm buying more of something I was buying yesterday. I'm buying it cheaper," he said during an October 2014 interview with Fortune magazine. Buffett's approach offers a different way to view those unsettling red numbers in your brokerage account. He likened it to grocery shopping, where finding items at a reduced price is seen as a win. Yet when it comes to stocks, most investors don't apply the same bargain hunting mindset. This is true. Most people, if they buy something and it goes down, they get a little bit rattled. They buy it with the hope that basically it appreciates in price. And so for the average investor, certainly seeing a stock that you buy go down is disturbing. The article continues. They think the stock knows more than they do, so that when the stock goes down, they say the stock is telling them something. They take it as a kind of referendum on themselves, me versus the stock. If it ever gets back to what I paid, I'm going to sell it, he observed. A drop in stock prices for Buffett signals the chance to get more for his money. So, for most people, this is pretty hard kind of philosophy to adopt. Most people are not so certain about their investing analysis. In fact, most people do very little investing analysis. And so, when you buy a stock and it goes down, that's bad. And I mean, from a practical point of view, your timing's off. Clearly, you could have waited. You would have been better off waiting and then purchasing it at a lower price. So I think it's okay that people sort of question themselves if we're only, questioning their timing. Maybe not overall their investment thesis, but certainly their timing, could have been improved. So the article continues. Buffett emphasized that the stock market is indifferent to an individual's investments, adding that worry about how a stock performs relative to its purchase price is futile. Stock doesn't care what you paid. You have to remember the stock doesn't even care that you own it. Well, that's true. But Buffett acknowledged there's one question that needs to be asked by investors. Can I get more for my money someplace else? Well, I mean, ultimately, that is the question. If you purchase something, it goes down. There's certainly other things that you could have purchased that have gone up, unless the stock market in aggregate, unless the entire stock market is in a crash or free fall. There's almost certainly a stock that's going up somewhere and someday. So you've got a chance to be in thousands and thousands of great businesses, and their prices change all the time, so their relative valuations change, he added. Indeed, there are thousands of companies listed on U.S. stock exchanges, and thanks to minimal commission fees, investors can readily shift their capital to where they see the best value. This is true, and it is kind of interesting. And one of the things that really good investors talk about is, not just investing in a ticker, but investing in a business. Really buying into the whole investment thesis. It is true, however, that they've done studies on momentum investing, and momentum is clearly a factor. Momentum clearly propagates itself, all things being equal. So stocks that go up tend to continue going up, and stocks that go down tend to continue going down. Now, there are some stock traders who are enormously successful taking advantage of that. But in general, that's a tricky thing to do, to buy a stock that's already high and you're buying it because you're sort of chasing after the momentum and the return. that can be a dangerous thing to do for sure. The article continues, you have a huge advantage over Andrew Carnegie, Buffett said. When he was in the steel business, he was in the steel business, or Rockefeller was in the oil business. He could not shift over immediately to retailing. And so obviously you as the individual investor can do that. You can be entirely invested in one industry, sell everything in a couple minutes, and then reallocate that capital into some other, different industry. And so he's just pointing out the fact that historically, business tycoons were all in one industry. The article continues, this flexibility is starkly contrasted with the monumental effort and resources required for past tycoons to change industries. Today, retail investors can easily diversify or reallocate their investments across different sectors with just a few taps on their brokerage apps. That's true. Buffett says he believes today's investors have the potential to build their business empires by investing in stocks. And most people, again, don't think about it that way. Investors don't think about building a business empire via the stock market. But he cautioned that flexibility can be a double-edged sword. While it allows investors to make swift moves, it can also lead to hasty decisions. It is a huge advantage which people turn into a disadvantage, he warned, adding that the practice of making investment decisions based solely on stock price movements is misguided. It is misguided, I would say, for the average investor, and it's probably not wise, but for a studied trader who's really practices his craft and can look at trends and is disciplined with his capital, I think they can be very successful, trading momentum. He says there's nothing about the price action of a stock that will tell you whether you should keep owning it. Over a long period of time, that's probably true, but not over a short period of time. So how should investors use this edge? Specifically, what should guide an investor's decision to sell one stock and buy another? Buffett explained that the decision to hold onto a stock should depend on what your expectations are for the company's future performance as opposed to how much the stock is worth now. And the article finishes up. In other words, the decision to hold or sell a stock should not be dictated by its current instability, but by a thorough analysis of its prospects. Investors should weigh the expected performance of the company against its current market price and consider how it stacks up against other ventures. I would say for the average person, that's really very difficult. I mean, Warren Buffett has a team of analysts. Warren Buffett has access to inside information. So the type of analysis that Warren Buffett can do, really the average person can't do. Building a fundamental model from the bottom up for prospects of a company is extremely time-consuming and very difficult. Just looking at data, performance data, and stock market data, and seeing what the chart looks like is actually very easy to do. And I would actually say, for someone who's very disciplined and motivated, they're actually better off trying to trade than they are to implement like a Warren Buffett style stock investing regimen. So that's my feelings. What do you think? Why don't you, if you could, leave a comment in the comment section below. I'd be interested in getting any feedback. And please, when you get an opportunity, like this video and subscribe to my channel. Thanks so much.